How to build wealth in inflation. With inflation in the US over 7%, the highest level in more than 40 years, there is some truth to that remark. One must wonder what effects this will have on other parts of the economy. Perhaps more particularly, how this affects your money. Warren Buffett, the Oracle of Omahas, has famously said in his investor letters when explaining the misery index that a large rate of return means absolutely nothing. But before we begin, please like and subscribe to our YouTube channel for such amazing and informative videos. If it comes with a large inflation rate to match as the two just end up offsetting each other. When you add other related investing fees and taxes, you might actually end up in the negative, and hence the misery index at 7% per annum. Inflation is pretty much one of the biggest eroding factors to your funds right now. So how do you invest in such a tumultuous time? What do you do to protect or insulate your money? If these are questions that are heavy on your mind, then let me ease your worry and bring you the keys that will help you know how to invest during high inflation. For those of you who have been around long enough, dating back to the late 1970s and early 1980s, you can attest that inflation can be a portfolio killer because it erodes purchasing power, and this hits heavy. But for those of you who have not been paying enough attention in class, let's recap what causes and then happens in high inflation periods. In a market economy, prices for goods and services can always change. Some prices rise, some prices full inflation occurs if there is a broad increase in the prices of goods and services. Not just of individual items, it means you can buy less for $1 today than you could yesterday. A textbook definition would be inflation is the decline of purchasing power of a given currency over time. As the definition shows, it's not good for any economy to have high inflation continuously, as it erodes the purchasing power of money. To deal with this, the Federal Reserve plays around with the interest rates as a tool to combat inflation. Hiking interest rates reduces economic activity in the country and thereby lowers inflation. As prices decrease in an inflationary environment, interest rates are likely to eventually rise, thereby negatively impacting fixed income securities at a macro level of global and domestic markets. Inflation is one of the risk factors which impact economic cycles and can disrupt countries, if not economies. In addition to wealth, with this background on how high inflation can affect your portfolio, let's look at ways that you can invest in a way that gives you an upper hand. Trust me, this is information you want to know if you are an investor in today's volatile market. You definitely want to keep up with the most important financial news. And that's where today's sponsor, The Daily Upside, can help you. The Daily Upside is a totally free financial newsletter that I myself read first thing in the morning. It's written by a team of former investment bankers, journalists and scholars, and it's about a 5-minute read. The newsletter is both informative, entertaining and insightful. They don't just give you a standard take on the news. It's the most important news with real analysis. Recently, they covered a story about Asana CEO who actually bought $1 billion of his company's stock in the public in a market where it seems like almost every executive is selling their stake. I bet it's good news to assign as investors that the CEO has confidence in his own company as someone who looks to stay on top of news to help create videos like this. It's free, and if you don't love it, you can always unsubscribe. People get too carried away. And first of all, they try to predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. This is if anyone predict interest rates right 3 times in a row, they'd be a billionaire. There's not that many billionaires on the planet. It's very, I took logic side a syllogism and study this one as a Boston college. They can't be that many people who can take the interest rates because there'll be lots of billionaires and no one can predict the economy. I had a lot of people this room around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I saved all the stuff. I don't remember any time we have the worst recession since the Depression. So what I'm trying to tell you, it would be very useful to know what the stock market's gonna do. It'd be terrific to know that the Dow Jones average year for now would be X. We're gonna have a full-scale recession or interest rates gonna be 12%. That's useful stuff. You never know it though, you just don't get to learn it. The upturn or M1 and M23B and all these M's. It's a very good indicator when I own hotel stocks and hotel occupancy. I don't know what's happening price of athletes. These are facts. Aluminum inventories go down 5 straight months. I can deal with that home affordability. I want to know about my own Fannie Mae and I own the housing stock. You can. They're economic facts of this economic predictions, and economic predictions are a total waste and interest rates. Alan Greenspan is very honest guy. He would tell you that he can predict interest rates. He can tell what short rates are going to do the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. They'll say, I don't have any idea. So how are you? The investors' interest rates, if they had a Federal Reserve, can't do it. I think Peter Lynch, one of the godfathers of Wall Street, has said it better than I ever could. Trying to predict what the market will do, how the interest rates will act, and investing on that basis can quickly turn into a fool's errand. Instead, there are investing steps you can take that can help your portfolio, not just in these high inflationary times, but even in an environment that has increased volatility and sharp turning movements. In short, the best way to invest in high inflation periods is to invest the regular way you always have, maybe with just a little bit more care, as I will soon show. Let's dive right into the keys. Key 1. Review your investments. This might sound like an obvious thing to do, but the first thing I would advise you to do is to review your investment based on your investment goals. It's always a good idea to periodically review your investments and financial goals. But in the current environment, it's worth doing that sooner rather than later. If you work with a financial advisor or a portfolio manager, have them rerun any gold projections using a higher inflation rate. Most models, for instance, to assume a 3% inflation rate in your projections in the current economy is just setting yourself up for disaster, as it is way too low if you're planning to retire in the next few years. This first key is something that is most important if you're looking at the edges of retirement, or you're looking at withdrawing part or most of your money from the market soon. Generally, clients should have a portfolio that can withstand some inflation, says Seth Mulliken, a CFP and founder of North Carolina-based Lattice Financial. If that's the case, there may not be a lot you need to change. But investors who have portfolios that are primarily invested in fixed income for safety may want to reevaluate, most likely. So, if you're interested in learning more amazing facts, make sure to subscribe to our YouTube channel and hit the bell icon to get notified by our new videos. Please like and share the video. Don't forget to comment down your views on this. Thanks for watching till the end.